Cool. Okay, so today's session is probably going to be a little heavy. It's going to be a little technical. It is talking about how do we calculate how much insurance you should have, because I don't think it's any great revelation for people to learn that every person has an individual level of need when it comes to insurance. And then what our job is as advisors is to help people work out how much insurance you actually need, give you the price and what that would look like, and then you can decide how much insurance you actually want. There are some other models in the market where they will take instructions from you and you say, well, I want X dollars of insurance. They will then go and find you the provider and place that cover for you. My approach is different. We help you work out exactly how much you should have. Being an independent advisor means that we are not reimbursed or compensated by the commission on the policy. So what that does is that means that while the figures we're about to go through today might seem quite big, what I like about being independent is it removes that possibility or appearance of a conflict. So the cover that we're recommending people, I can say hand on heart, it's actually how much you do need. I'm not inflating the cover to inflate the premium and thus inflate the commission, which has been an accusation put against advisors in the past. So let's move on to this. Now, this is probably the most important session for the warning that I've ever recorded so far. This is a general advice warning. What it's really saying is what we're talking about today does not take into account your personal circumstances or situation. Therefore, it should not be treated as a reason to take action, or it should not be treated as personal advice. When you see a personal advisor, you will get a very bespoke, very detailed level of advice that's tailored to your circumstances. What we're doing today is not it. The case study I'm going to go through today is simply for illustrative purposes. It is simply there to try to help you show you the structure that I work through when I'm determining how much cover you need. You may then go away and you work out your numbers yourself, and that'll dictate the amount of cover you should have. And then you can make inquiries with other providers, with existing providers, existing advisors, us, whomever. But just know that the numbers that I'm about to go through today do not apply to you. So please do not replicate the amount of cover that we're covering, unless your personal case study literally exactly matches what we're talking about. So a quick refresher around the different types of insurance. So talking about our last session where we did a really in-depth introduction to what insurance actually is. There's 4 types. I need to confirm whether or not there's a video on my screen blocking the income protection square. I hope it's not the case for you. There's 4 types of insurance. There's life or death insurance, TPD cover, trauma insurance, and income protection. Life insurance pays out if you die. TPD pays out if you are totally, permanently disabled. Trauma pays out in the event you are diagnosed with a critical illness, a defined illness. And income protection pays you an income stream if you're unable to work for a period of time. Now, I'm not going to cover income protection today. It's a kind of a different beast. Income protection pays you up to 70% of your gross income pre-tax after a waiting period of either 30, 60, or 90 days, and it'll pay you through for either 2 years, I think you can still get 5 years, through to the age of 65. So there's a bit there. I'm going to exclude that. We will reference it later on, but I'm not going to hop into it in more detail. What I'm really concerned about today is taking you through how we calculate the level of cover you should have for life, TPD, and trauma. So all of this boils down to working out exactly how much you need to have. And as I said at the top, your needs are going to be very different to every person you know. Your needs will be different to your partner's needs, simply because you will have different super balances, you'll have different priorities, you'll have different loan amounts, you'll have different personal debts, all aspects of that. So this is very much trying to give you that structure to help you work out how you can determine the level of cover you need. So you've got a few options when you're calculating this. Frankly, there's the kind of do nothing option, which I've left off here. You can just not have insurance. Very common option. I won't speak to the validity of that option, but it is something that a lot of people do. Second along the spectrum, there is this idea of automatic cover, which is the coverage you have through your superannuation, or decreasingly commonly through your work. That's something that used to happen quite a lot. It's kind of less common now. A lot of tradies will have something in that. A common method, what I would consider an old-fashioned method, I've been doing this for 17 years and it was kind of phasing out when I started my career, is this idea of doing it as a multiple of something. Commonly, it was a multiple of income. So if somebody was making 100K a year, you'd look up this little table and you'd say, okay, at their age, they should have 12 times that. Let's place them with $1.2 million of cover. Advantages of it, it's a really good and easy rule of thumb. Disadvantages is it doesn't really have any connection to their needs. What if that person has a $1.4 million mortgage? Yeah, it just kind of gets a bit blunt. Another one is a multiple of debt. I've seen that before, but multiple of income or multiple of revenue for a business tends to be the most common one. My preference, though, is a full and detailed needs analysis. So it's often called an insurance needs analysis. We put an acronym to everything in my practice, so it's INA, but it's all based on your needs. So it's a series of questions that we'll go through. We use a like an online form. It's anonymized. We use a method. We give you a code so that we know who it is, but I don't want your details going through publicly. And it just asks you a series of questions. And it all boils down to, in the event of your death, do you want this to happen? Yes, no. Do you want this to happen? Yes, no. But it's a series of, it'd have to be 25 questions, I think. At the end of that, we have enough information to generate a personalized, robust, very relevant level of cover for you, which summarizes it in the table. We provide the advice and we say, Mr. Jones, Mr. Singh, you have this level of exposure in your current financial circumstances that in the event of your death, you need to have X dollars put aside. In the event of your disability, Y dollars. Trauma, Z dollars. I'll put in here the final note that it is an adjustable amount. Now, this is my recommendation of how much you need. I reckon in my career, 20% of people have taken the full recommendation. Everybody adjusts it in some way, which is great. What I want you to know is, okay, here's how much I really need. Here's how much I can afford. I'm just going to have to carry that gap. But I can say to the dollar, that's the amount of gap I'm willing to absorb. If not, you need to spend more on your insurance. You close that gap, but you're decreasing your net income. So it's a more informed and, sticking to the theme of this whole series, a more intentional decision around what you're doing with your insurance rather than just saying, a super fund's giving me 100 grand of cover, 10 times my income is X. This is actually really, really bespoke. So a question I'm often asked is, what can I cover? Most people, we obviously work closely with the team at Loan Gallery. Most people that come through, their answer is, I want to cover the mortgage. Cool. We can help you organize that. What about everything else? And it's that everything else that I think doesn't really get discussed or considered very much beforehand. Because the reality is, when it comes to working out what you can cover, it's kind of anything. Insurers have limits in how much when they're assessing your cover. And the limits are, if you want more than $1 million worth of cover, we will require these additional tests. You will require a more in-depth blood test or an exercise ECG or things like that. We might need statements from your accountant, etc. But if you can substantiate what you're trying to cover, they will essentially provide you coverage of any amount, subject to their limits as well. So you can't have $10 or $20 million of TPD cover. But if you can substantiate what your application is for and what that number is based on, then they will cover you. They'll just charge you the premium. It doesn't bother them, kind of. So let's move into the nitty-gritty. We're going to go through a bit of a case study here, but I want to explain that when we're going through a needs analysis, I operate on covering two different aspects of your financial situation. The first one is the capital expenses, the lumpy expenses that come as a result of these events that you want to make sure are covered so that if you should pass away, if you should be made disabled, if you should fall seriously ill, your family, you will get a lump sum of money that you can take care of these big expenses and never have to worry about them again. Your family, we'll talk about that. The other aspect is the cash flow piece. Now, if you've passed away, what is your family then going to live on? Will your surviving partner have sufficient income to support the family the way they're accustomed to or the way you want them to? Are your children, if you have children, so young that your surviving partner may have to stop working to care for them? Will they need to change their career? Will that diminish their ability to earn an income? If you have decided to send your kids through private school, do you want that to still occur if you've passed away? If you have been made disabled, how are you going to cover the ongoing medical costs? So, the common example of TPD is that you've wound up in a wheelchair. Okay. How are you going to cover the costs of perhaps some ongoing medication, ongoing rehab and physio treatment? Sometimes a home nurse, even a respite option to try to give your person who's looking after you 3 or 4 days break a month. That's all an ongoing regular cost that will continue for the period of your life. So it's really about balancing out, okay, here's the capital that we need to inject into this family's financial situation to make sure that they don't get wiped out by the loss of that income, by the loss of that person in their life. And on the cash flow piece, how much do we need to create as a regular income to meet these ongoing expenses that either already existed, like school fees, replacing the spouse's income or your income, or are now a new and additional expense like ongoing medical costs? So what we do is each of these components has subcomponents. We work out those numbers. This is where those 25 questions kick in that I talked about earlier. That spits out a big number, and that's how much we recommend you take out. So let's hop into the case study. The investment loans bit down here, we'll come back to because it's kind of an interesting consideration, and everybody has a different approach. So when we're talking about capital, we're talking about initial medical costs. I'm going to say the phrase, if you're still here. Life insurance means you're not here. TPD and trauma means you are here. Now, because you are here, it tends to be more expensive. I think some people typically have less disability cover than life cover, and for most people, that's the wrong way around. So it'll cover initial medical costs, renovation and adjustment costs. So let's say you do end up in a wheelchair, you are going to want to stay in your current house, you are going to need to widen your doorways, you're going to need reduced bench heights, you're going to need to improve access to the house through ramps, you may have to install a different shower or bathing system, you may need to install lifts and what's it called? Hoists to move you in and out of bed. You may need to buy a new car because you may need to have a different capacity or different capability vehicle. That's all very expensive. You may even just want a whiz-bang wheelchair, and they can be really dear, if you want a really, really good one. We also provide in the capital side for final and funeral expenses. So these are one-off expenses, kind of chunky costs. And this is, again, we're going to go through the case study, but this is very different. So in my case, my mother passed away a few years ago, and she was very clear on how she wanted the funeral to go. Some people in my family thought that we should step it up a little bit. It cost us $28,000, including buying the plot, the coffin, burying her. Now, she had insurance put aside, so it was fine, but it was a $28,000 expense. It's then cost another $5,000 to $10,000 plus the time and effort to settle the estate. So in that case, a $40,000 to $50,000 injection of cash would have left my siblings and I kind of square. So mum had cover for 25 grand, so it worked out part of it. But to go the other end of the equation, I'm working with somebody at the moment whose husband passed away earlier this year, and he had, how do I put this? Rather lavish tastes when it came to final memorials. And her funeral costs and her memorial costs and the plot and the monument and everything is 100 grand. So it's a matter of maybe being a bit conscious of what your cultural expectations are, family expectations are, and thinking to put aside that money, because you don't want to leave that bill, you don't want to leave that bill with your family to find the need to do. So it's going to be quite an easy factor of just chucking on an extra $20,000, $30,000, $50,000 on your life cover. Gifts and bequests. This is where things can get a little bit hairy with insurers. They don't necessarily like these, but if you've got a big family or if you've got a charity you really want to support, you can allocate an amount through that. It gets very complicated with wills and things like that, though. A quick note on wills. I think I may have raised this in the last one because it's something that's I've relearned in the last couple of weeks, and it's really stuck with me that through a will, if your life insurance is diverted into your will via your legal personal representative, your executor cannot use that money to clear your loan. It has to be paid out to beneficiaries who can then choose to pay out the loan. It doesn't really make a material difference, but I think it is worth being aware of that when you are filling out that beneficiary section and also just preparing your family. All right, cash flow. We need to replace incomes. We need to cover ongoing costs. We've talked about all of that. So let's hop into this case study, and I'm not going to name them. I'm not going to go into great detail, but this is a 42-year-old employee who she's the primary breadwinner of the family. She brings in, I think, $80,000 a year of net income, and that supports their lifestyle and covers their expenses. He also works part-time, and he brings in another, I think, $50,000 a year, which primarily will go towards the kids' school fees down the track, is their plan. Okay, so in the event of death, in the event of you passing away, what do you want to do? Is the question we open with. And in this case, let's assume that they have said, in the event of my death, I want to Clear my mortgage. Mortgage is $650,000. It's held over a house that's worth about $900,000. So mathematically, we're already hitting somewhere where there's a bit of discretion. Because mathematically, you could say, well, sell the house. Sell the house, clear the mortgage. You've walked away with $250,000. Well done. Now, the glaring issue there is that then the family doesn't have anywhere to live. So it's not really an option. So it's more important in this instance than in most instances, I think, to then clear the mortgage. Use the insurance proceeds to pay that out. Leave the family with the ownership of their house free and clear. That way they don't have that ongoing expense and they have perpetual security over where they're living. Now, this person may also have some credit card debts, a personal loan or a car loan. They want all that cleared in the event they die as well, $45,000. Provide enough to cover the funeral costs, so we're talking $30,000 there. And then finally, at the end, as a gift to the family, I would like to fund one holiday for them to take after I'm gone. And allocate $30,000 for my husband and the two kids to go on a nice holiday and not have to worry about money and just get away from everything. Very quick side note. I've had people in the past tell me how morbid it is to talk about death and talk about disability. And I can understand that. I know that there's a lot of discomfort for people talking around this topic. But it doesn't take too many interactions with people that are left behind when somebody dies without planning it, without talking about it. It doesn't take too many discussions with people in that boat to realize that it's really important that we push through that discomfort, have these conversations now, get the advice, get the plan, and then put it to the side. Talking to an estate lawyer a little while ago, and they called it a proper estate plan is your last act of love for the people you leave behind. And I think having this uncomfortable discussion and getting this insurance sorted, it would have to be the second last, just to fund everything. So in terms of capital, this person wants to have enough to clear $755,000 worth of capital expenses in the event of their death. Now, we turn to cash flow. They are earning $80,000 a year of net income. Net income is very important here. There are taxation consequences for how you structure this portion of things. Let's assume in this case, it's just a capital drawdown. They get the money, they plonk it in the bank. There's a little bit of interest, but they're just drawing down 80 grand a year to live. So this person, my $80,000 net income supports my family. So I wish to leave enough for my husband to not have to go to work until our youngest, who is 6, is at high school. So that's 6 years at $80,000. A blunt, simple arithmetic, $480,000. When we're talking about these larger numbers, we will often do a present value calculation. So this is a 5% discount rate, which says that over 6 years, $80,000 a year, if we're making 5% a year, we need to have $417,000 of capital put in the bank. And the end of that 6-year period, that will be entirely depleted. That's the goal. It's also important to this person and their husband that their 2 children attend their preferred private secondary school. Now, neither of the kids are in that secondary college at the moment, but when they do, they estimate the fees will be $20,000 a year each, plus $5 grand a year of additional costs. School camps, uniforms, books, laptops, all the stuff, excursions, all those sort of things. Now, anybody with kids in private school will know that that $20,000 estimate is good for about 6 hours because those fees increase all the time. However, we have taken a step in the dark and we've just used $20,000. Now, in the event that that becomes unaffordable, their husband will have the decision of what they're going to do. They can either go and work, find more income. They can change the school of the kids, however they do it. Because the alternative is that we allow for a $30,000 annual fee or a $50,000 annual fee. And you can just keep going and going and going. And all of that ends up doing is blowing up the gross need. And keeping in mind that we are trying to strike a realistic balance here between what you need and eventually what you can afford. Now, ideally, in most people's circumstances, they would love to cover every possible expense and leave their kids and family living in the lap of luxury. So every person that we sort of talk to could do with $5, $6, $10 million of life insurance, but it's excessive. We're not trying to upgrade life. We're trying to replicate and supplement the life that you would have had you have stayed alive. So in this case, $300,000 because we're talking about 25 grand each for 6 years each. So it's $50,000 for 6 years or present value 266. So cash flow somewhere between $683,000 and $780,000, depending on whether you've discounted it or used the gross figure. So that gives us a lump sum. Those that are keeping track, you will have seen, we've got a capital figure, we've got a cash flow figure, that's our gross need. But then we can subtract from that the other resources that people have that they can bring to bear in the event of their death. And superannuation is, for most Australians now, the biggest and most liquid asset that's paid out upon their death. So in this case, they've got $265,000 in there. Now, legally, when somebody dies, the super fund trustee is forced to pay that money out as soon as practicable. And that's the word practicable. I don't know why they don't use practical. I'm sure there's a reason. So what that means is they need to identify who the money goes to and get it out of the system as quickly as you can. So in this case, $265,000 will drop into the estate or their beneficiaries' hands. On top of that, the family's got 50 grand of cash just on hand, saved in the offset account. They've accumulated $35,000 of shares. And in this case, the person who's passing away in this instance, they have a car and personal effects that they think they can sell for about 25 grand. So in the event of their death, they can bring $375,000 to bear against their overall need, which gives us this table. So capital need, 755 grand, cash flow need, 683 to $780,000. Subtract from that 375 grand of additional resources, this person needs to have somewhere between 1.06 and $1.16 million of coverage. So another way to say that is they have 1.06 to $1.16 million of exposure in their family and financial circumstances if they were to pass away. This is going to feel like a big number because if you remember back to their first inquiry, maybe they just wanted to cover the mortgage, and it's a completely valid approach. 650 grand, clear the mortgage, your family's going to be in a much better position than if you didn't do that. However, how do you replicate that income? Do you want to take the kids out of private school? How do you want to structure things? And this is where having this context built makes that next conversation about affordability really easy. Because then it's like, look, here are the numbers. You need $1.16 million of cover. That's going to cost you X with the insurer. You're telling me you want to spend less than that. You want to trim 30% off that. Where do you want to cut coverage? And that's fine. Like, it's, again, no commission. I'm not engaged either way. But that can be really challenging. It can be kind of a hard conversation. But 1.06 in this case. Moving on from that to TPD. So in the event of disability, what do you want to have happen? In the event of disability, I want to clear my mortgage, clear all my other debts. If I'm ending up in a wheelchair or if I'm simply unable to work ever again, I don't want a mortgage hanging over my head, and I really want that credit card and personal loan gone. I want to provide for those upfront adjustment costs. Now, we've used 150,000. We have some default figures in our calculator that are a combination of plucked from the air and based on research that we've done around average disability costs. In essence, you can put any number you want here. So if you live in a 2-story house and the kitchen's upstairs, but you want to retain the house, then you will need to look at putting in a lift. You will need to think of moving the bedroom downstairs, broadening doors, broadening the front door ramps, lowering the kitchen and the bathroom benches. You'll probably need to install some sort of new toilet or mechanism to allow you to self-toilet, I think is the word. So 150 grand may be enough, it may not be enough. What I do know is that it'll be more than you currently have allocated to these expenses, and your family and you will very much appreciate it. The NDIS has kicked in a lot here and it's helped dilute a lot of these costs. But even so, you're not going to regret having an extra $150,000 in your pocket when it comes to trying to manage treatment. Wheelchairs can cost 5 figures. So you're going to incur a fair bit of cost. So capital costs, we're looking at $845,000. Cash flow, $80,000 net income supports the family. This is where income protection would kick in though. So if you were to be made totally and permanently disabled, you would claim on your income protection, pulling that 70% off your net gross income and live on that as a family. So you'd be able to maintain living expenses. Now there is a debate that people should be topping up their income from 70 to 100% using TPD cover, which you can do. However, for most people, their mortgage payments are making up 30 or more % of their salary. So getting rid of the mortgage payments should leave them in a net improved position doing this. Again, this is why you get formal professional financial advice from a professional advisor because there's so much nuance involved. I'm kind of hitting you over the head here with some bluntness. So we'll leave the income protection, but it is the private school piece. That's all valid. This person still wants to make sure their kids can go through that secondary college. Now, if they're not working and even living on income protection, they know they will not be able to find an extra $50,000 a year to meet their costs. So we're going to use insurance to offset that. Now, how is this treated in the event of a claim? You're generally with TPD, you are the beneficiary. So the money will be paid out to you and you will then have choice of what to do with it. Most people will park this money in a bank, in a term deposit or a series of term deposits, and just pay the payments as they go. So at least you're making some interest along the way. They also want to make sure that they're provided for the likely ongoing medical costs that would come up. Now, this is where we're talking about a huge gamut of things, which is why you can see I've allocated $40,000 to $80,000. This is another how long is a piece of string kind of thing, because if you are permanently disabled, you might end up having bills of $150,000 a year because you just want to have the best of everything. You need to live somewhere different. You need around the clock care. Yours may be a very severe disability. Not that there's unsevere ones, but this might be one that's completely incapacitated and you are 100% reliant on other people to function and to live. So we often put the question to people and say, how much would you like to allocate towards annual medical costs? So if you are, not entirely dependent on other people around you when you are made disabled, perhaps $40,000 a year will help offset medical costs. If it's going to be more required, then maybe $80,000. So this is where we can make adjustments based on your budget. The other variable here that can kick in and can have a huge effect on how much you take out is how many years you're looking to provide for. So you'll see here that this person's 42 years old. Commonly, you can either provide for these ongoing medical costs through to the age of 65, with the idea that at 65, Centrelink income will kick in, superannuation will have grown, NDIS will still be there. So you probably don't need this level of cover then to cover those bills. Or alternatively, you can run it through to life expectancy. So in this case, I've used 25 years for them at 65, which means they should be living through to 90. So I think 90. So that's when I've calculated out the numbers they need, but it's the number I've used. So cash flow, if they're looking to provide for $40,000 for 23 years, they need 920 grand. If it's to life expectancy, it's 1.92 million. If they're after $80,000 to the age of 65, they need 1.84 million. If it's through to life expectancy, that jumps up by $2 million, which is natural. I mean, it's 45 to 50 years at 80 grand. It's going to add up pretty quickly. So cash flow subtotal, I've used, what did I use? Yep. So I've used $40,000 to the age of 65 plus that for the school fees. Beg your pardon, $300,000 for the school fees. So $1.22 million they need to cover their cash flow requirements from now into the future. They've got resources. Superannuation pays out upon a TPD diagnosis. So they've got $375,000 they can put towards managing these new costs. 845 plus 1.22 minus 375 leaves them with a net exposure in the event of a disability to the breadwinner of this house of $1.69 million. Seems like a huge number. Generally, younger people will have a higher TPD amount. Older people, as they repay debt, as their period of 65 falls, then their coverage should also fall as well, generally speaking. Don't cancel anything based on what I just said. So that's TPD. In the event of a critical illness, I want to. Now, critical illness is I've been diagnosed with something like cancer, heart attack, stroke, motor neuron disease is in there, MS is in there, stroke, I've mentioned the strokes. There's normally about 20 to 25 headline conditions, and often beneath all of them, there's probably another couple. So cancer has, often you'll get a good quality trauma policy will pay out 100% on a specific severity of cancer diagnosis, but then we'll pay lesser amounts depending on lesser severities. So testing the knowledge here. Melanomas, for instance, have, I believe it's called a Clark level. A lot of the insurance contracts are built around the Clark level. So if you have a really high Clark level, whatever that'll be, it's probably going to be a high payout. If you have a really low Clark level, it might be a 10 or 20% payout. Now, in this event, a few things I should preface here. Trauma expensive is generally, normally, the most expensive cover dollar for dollar, because 1 in 3 Australians will have cancer before they turn 70. I think it's 1 in 4, 1 in 3. People will have a heart attack before they're 75. These things happen with more frequency, naturally, than death or disability. So disability is generally dollar for dollar the cheapest, kind of with life, because it happens so infrequently. So TPD, we talked about this, I think, in one of the risk webinars. TPD is a very, very low likelihood outcome, 1 in 20, 1 in 25 are the stats that I've heard, but an extremely high severity. So in terms of the overall risk, I consider that to be an impactful risk, because it may never happen, but when it does happen, it really happens. Death is a certainty. Timing of it, we don't know, but death is a certainty. The severity of the financial impact of your death is kind of fluid. As you get older, it can be lower. Trauma is very expensive because it happens so frequently. So as a result, my general model, and this is my very specific special source approach to this. Every advisor will have a different approach. But in my world, I like to cover the mortgage for 2 years, assuming a 10% interest rate. So they have a $650,000 mortgage. That's $65,000 a year at 10%, or $130,000 for 2 years. However, I want them to clear all the small debts: credit card, personal loan, car loan. Get rid of them. Just take them off your mind. It's 45 grand. It's worth the investment. Now, why 2 years? Frankly, at the end of the 2-year period, you will either be fully recovered and back at work, and your financial position will have recovered, or you will be permanently disabled, or you will be dead. So in the event of the latter two, you will be claiming on your other insurances. Now, this is where it gets very harsh and very blunt, because we need to be making financial decisions around things that we just don't know when they're going to happen or if they're going to happen. But in the event of them happening, we want to make sure we haven't overinsured you, because it will simply cost you too much money. So we also want to provide for the upfront medical costs. Now, this is another how long is that piece of string question, because $100,000, significant amount of money, tax-free, paid to you, that you can do whatever you want with it. Now, the reason I say it's how long's a piece of string is there are experimental cancer treatments that could save your life, that could cost you $500,000, and you have to move to the US to do it. There are heart attacks that people are back at work within 6 weeks, having spent maybe 30 grand. We simply cannot tell, and we don't want to tell, what medical condition is going to trigger a possible claim for you, and how severe it's going to be, and how much the treatment will cost. So essentially, we need to pick a number. I always use $100,000 because I think even if you're looking at 200 to 250K costs, 100,000 is going to get you a lot closer without costing you a fortune. Now, trauma contracts tend to have a $2 million limit. So you could just go and buy a $2 million trauma contract, be fully covered, but it's very, very expensive. So we're trying to keep a lid on it. The other piece is we want to make sure, so the capital costs in the event of a critical illness, you're looking at $275,000. The income protection will kick in this case if your illness is stopping you from working. So sometimes people have heart attacks, they're back at work in 6 weeks. They're probably not going to be able to claim on their income protection, but they should be able to claim on their trauma. So we want to make sure the private school's covered. However, again, we're sticking to a 2-year period, because we know that if it's more than that, they'll either be back at work, dead, or disabled. So $100,000, 25 grand per kid for 2 years, works out to 100 grand. Ongoing medical costs, we're going to use $40,000 in this case. Oh no, we used $80,000 because it's a shorter period, and because the treatments may be very, very taxing. So I met with somebody the other day. They've finished their rounds of chemo, but they are housebound. They can't go out in public because they might catch an infection, but also they're just so wiped, and they will be for quite a while. So we want to make sure they have enough income and money coming in to have that happen. This insurance is not going to prevent you having any of these horrible things happen. It's simply going to soften the financial impact of it, which softens the stress, reduces the stress of you and your family, which I would argue gives you a greater contribution towards recovery than maybe some other options. So cash flow, 180 grand. Yep, sorry, 100 for the school fees. Ongoing medical costs, 80. Yep, 180. So superannuation will not generally pay out upon a critical illness. So it reduces the resources on hand, and they may not want to sell their car and personal effects because they'll be using them again, hopefully soon. So $85,000 of resources comes off the top, means that this person has a financial exposure of $370,000 in the event they are diagnosed with a critical illness. Again, seems like a big number. Some people might say it's not big enough because it doesn't clear the mortgage, but I would say that the people that I've met, that's kind of an average. It's not out of kilter. So to summarize, they need $1.064 million of life, $1.69 million of TPD, 370 grand in the event of a trauma. So what they would do then is we would then provide recommendations around how do you plug that gap. And normally that means we're recommending an insurer. Some people choose not to do that, which is completely their prerogative, and they are doing what we call self-insuring, whereby they accept that if any of these events happens, they will be carrying the financial burden of that themselves in the interest of saving premiums today. So I've talked about the current promotion in the previous episodes. We're waiving all advisory fees. So you can get a policy with no commission, not pay the replacement fee, and be quite ahead. And I should say there is a wait list. We are not taking any appointments now until the second week of June. That's the way that we've just really taken off, which is great. Final question to talk about, and I'll keep this fairly brief, investment properties. So there are two schools of thought here. When it comes to life insurance, there is a strong benefit that comes with clearing the mortgage of an investment property as well as your home, at least one investment property, because it will then generate the income to help supplement your expenses. Excuse me. Well, that came out of nowhere. To supplement your expenses. The thing is, though, if you have a $600,000 investment property with a $500,000 mortgage, you clear that mortgage using insurance. That adds 500 grand to the amount of cover you need, but it might only add $25,000 to your net income. And then you're stuck with a property that you may need to sell or you may need to manage. So it's very much a bespoke discussion you should be having with your advisors. What do I do with my investment property in the event of my death? So what we will normally do is we will keep the property, offset the debt, or pay the debt down to a point where the monthly minimum repayments fit within the person's budget. So it gets very complicated and very fluid. I think most people would be pretty rapt to just pay out the property. But again, you're adding $500,000, $600,000, $700,000 to the top of an insurance need. And you saw already, you put that on top of that, that adds up pretty quickly. That's that. I've flown through that. I don't believe we had anybody join us. We did not. So I will wrap it up there. If you do have any questions, please send me an email, jordan.varker@theadvicegallery.com.au. We do have some more webinars coming up. They may still be out there by the time you're watching this. Otherwise, be sure to check them out on the YouTube channel. If you do have any questions, comments, criticisms, complaints, please feel free to get in touch, jordan.varker@theadvicegallery.com.au. And thank you. And until next time, I'll see you soon. Cheers.